Usually, gifts for estate planning purposes are meant to achieve one or more of the three goals listed on this slide. The first goal on this list is to reduce or eliminate transfer taxes, and by transfer taxes I mean estate, gift, and generation skipping taxes. The second goal on the list is to reduce income taxes, and the third goal on the list is to protect assets from claims against the grantor or the grantor's beneficiaries. It is not unusual for a gift to achieve more than one of the three goals. Often, the same gift can achieve all three of the listed goals. Gift planning is a very big topic, and I fear I won't be able to do it justice in this video series, and that what follows will be not much more than a brief list of some gift techniques that are popular at this time. Keep in mind, however, that planning techniques change as everything else changes. What is popular now may be obsolete with the stroke of the president's pen or new ruling by a court. Let's start with a discussion about gifts to trusts that are designed primarily to reduce transfer tax costs. In other words, they're designed to reduce estate, gift, and generation skipping taxes. Income tax results are always a consideration, but for this part of the discussion, the income tax result may be secondary. We will get to income tax considerations a little later. First on the list is the irrevocable life insurance trust, often called an ILIT. When your estate includes life insurance policies, even though you might not feel wealthy, the life insurance policy may provide benefits to your survivors that one might expect only a wealthy person could provide. We see quite a few situations where it's the ownership of the life insurance policies that will boost a person's estate up over the estate tax exemptions, and which gets us thinking about ways to reduce the size of the estate in order to reduce or eliminate the estate tax. A very good way to reduce the estate tax is to make sure that somebody else is the owner of the life insurance policy. Remember the rule: if you're the insured under the policy and you're the owner of the policy, then the death benefit is going to be included in your estate for estate tax purposes. So the technique is to make somebody else the owner so that at your death, the death benefit will not be part of your estate for estate tax purposes. When we think about making someone else the owner, usually an irrevocable life insurance trust is used as the new owner. So you enter into a trust agreement with your trustee. This agreement, however, is not revocable, it's irrevocable. We've spent a lot of time talking about revocable living trusts, and I don't want to create confusion. This type of trust is different. The type of trust I'm talking about right now is irrevocable, but like the revocable trust, this type of irrevocable trust is established by an agreement. In the agreement, you name a trustee, and when that agreement is in place, the life insurance policy is transferred to the trustee of the irrevocable trust. And if you survive the transfer by 3 years, then the death benefit will be out of your estate. That means that the life insurance policy and the death benefit payable under the terms of the policy will not be taxed as part of your estate at your death. Because of the 3-year rule, lots of times it makes sense to set up the irrevocable trust and let the trust buy the policy instead of you buying the policy and then transferring it to the trust. In other words, if you buy the policy that insures your life, and if you then transfer the policy to the irrevocable trust, and if you die within 3 years of the transfer, the death benefit will be included in your estate for estate tax purposes. So it would be better for you to set up the trust first, give cash to the trust, and then let the trust purchase the policy instead of you purchasing the policy first, setting up the trust next, and then transferring the policy as the last step. That avoids a transfer of the policy, and as a result, you avoid the 3-year rule. Also, remember what we mentioned earlier in this video series when we talked about life insurance. For estate tax purposes, You may be treated as the owner of the policy even if the policy paperwork shows that someone else is the owner of the policy. Remember that you'll be treated as the owner of the policy for estate tax purposes if you have any incident of ownership, such as the power to change beneficiaries or to borrow on the policy. If you're a trustee of the trust that you set up to own the policy on your life, as trustee, you would likely have an incident of ownership over the policy, so you would not be able to serve as trustee of your own life insurance trust. There are other gift techniques that clients consider for transfer tax purposes that we'll briefly mention now. They're used when the client is interested in doing more sophisticated things to get the value of their estates down. For now, in 2019, there may be less interest in such techniques because estate tax exemptions are much higher than they've been in the recent past, but keep in mind that lower exemptions may return as a result of another election that may be just around the corner, and, in any event, lower exemptions are scheduled to return in 2026. Clients may want to think about taking advantage of high exemptions now by making gifts before the exemptions are reduced. One technique relates to your home. It involves an irrevocable transfer of your home or a vacation home to a trust that is known as a Qualified Personal Residence Trust, also known as a QPRT or QPERT. The terms of the trust say that you retain the right to live in the home for a period of time, and after that time expires, others, usually younger generation family members, such as your children, become the owners of the home. When you retain the right to use and occupy the home, it results in a reduction of gift tax costs because the value of the gift is reduced to reflect your retained right to use and occupy. Another technique deals with transferring income-producing assets, not your home and not your vacation home, to a trust, and you retain the right to receive an annuity from the trust for a certain number of years, and then, after that period, your trust beneficiaries, and we call them remainder beneficiaries, are entitled to the assets. You, the grantor, retain no rights to receive anything except the annuity from the trust. That trust is known as a grantor retained annuity trust, also known as a GRAT or GRAT. When the grantor retains the annuity for himself, it results in a reduction of gift tax costs because the value of the gift is reduced to reflect the grantor's retained right to receive the annuity from the trust. If the actual investment return on the assets transferred to the GRAT exceeds the rate the IRS uses for imputing a value to the gift, there's a tax-free transfer to the remainder beneficiaries. There are a number of variations on that GRAT theme. The next trust on the list is the Intentionally Defective Grantor Trust, also known as an IDGT, which we can refer to as an IDGT. When you use an Intentionally Defective Grantor Trust in your estate plan, you're using estate, gift, and generation skipping tax exemptions to irrevocably transfer assets out of the grantor's estate to the beneficiaries. The beneficiaries are usually members of the grantor's family, and ultimately they are in generations younger than the grantor's generation. The trust receives gifts from the grantor that are shielded from tax by the grantor's transfer tax exemptions. As mentioned previously, currently, in 2019, the federal estate tax and gift tax exemptions are $11,400,000, and similar exemptions are often lower for state transfer tax purposes. Frequently, plans that involve gifts to IDGTs are used together with techniques that take advantage of certain valuation discounts for gift tax purposes. A common feature of the IDGT type trust is that the grantor retains the income tax burden. As a result, when the grantor satisfies the income tax burden, the grantor makes indirect tax-free gifts to the trust beneficiaries that is equal in value to the income tax burden. That's what it means when this type of trust is referred to as defective. The grantor is taxed on the income that the grantor does not receive. Once upon a time, that result was considered a defect. Now it can be considered desirable. Because historically it has been referred to as defective, The reference has stuck, even though the defect is now often considered desirable. The intentionally defective grantor trust is often employed to purchase assets that are expected to increase in value. Because the trust is defective, for income tax purpose, the agent can make the purchase and the grantor can make the sale without recognition of a taxable gain. For income tax purposes, the sale to the agent is treated as if the grantor sells the asset to himself, so no taxable gain or loss is recognized when the agent buys the asset. In effect, the sale results in a transfer of future appreciation to the trust and its beneficiaries without paying a transfer tax in the form of an estate or gift tax and without paying a capital gain tax. The next trust on the list is the Spousal Limited Access Trust, also known as an SLAT or SLAT. The Spouse Limited Access Trust is a type of intentionally defective grantor trust which usually gives the grantor's spouse generous benefits and powers over the assets of the trust during the spouse's lifetime. The grantor's hope often is that, if necessary, he will indirectly receive benefits from the trust through his spouse. The Dynasty Trust is the next trust on the list. A dynasty trust can be any trust, including idiots and slats, that continues for a long period of time for the benefit of younger generation beneficiaries, usually for more than one younger generation, with the intention of providing estate, gift, and generation skipping tax benefits, as well as asset protection. Such a trust can continue for as long as the law allows, and during that time it protects the trust assets from estate taxes in every generation, while also protecting the assets from creditors. Let's take a moment to mention Section 678 trusts, because not only can they be useful for efficiently making gifts for estate and gift tax purposes, they can be useful when planning to maximize income tax deductions that relate to pass-through trades or businesses. The reference to 678 is a reference to Section 678 of the Internal Revenue Code. When the client makes use of a Section 678 trust, he irrevocably transfers assets to the trust and gives the beneficiary of the trust a right to withdraw an amount equal to the value of the assets transferred to the trust. If the right is not exercised by the beneficiary by the end of a period of time described in the terms of the trust, the power to withdraw lapses and the asset continues under trust management as provided in the terms of the trust. Transfers to a Section 678 trust can be an efficient way to use estate and gift tax exemptions, as well as an effective way to transfer income to the beneficiary for income tax purposes, even though the beneficiary may not actually receive the income. This technique can reduce the grantor's taxable income, which may help the grantor qualify for the pass-through income deduction, and it increases the beneficiary's taxable income in a way that can make the income that's transferred to the beneficiary for tax purposes qualify for the pass-through income deduction. If you would like more information on how the pass-through income deduction works, please see our video series entitled How the Tax Cuts and Jobs Act Affects All of Us by me, Richard Land, posted on YouTube. Although the rules that apply to the charitable lead trust are quite different from the rules that apply to GRATs, the basic concept is similar. The value of the gift of remainder interest to family members is discounted because the family members must wait until a preceding interest in a charity terminates. In a GRAT, the preceding interest that terminates is what the grantor retains for himself. In a charitable lead trust, the preceding interest is a regular cash flow to a charity. The gift of the preceding interest to the charity is not subject to gift tax as a result of the gift tax charitable deduction. Now let's talk about gifts that you might make primarily for income tax reasons. As mentioned earlier, once upon a time the purpose of a trust might have been to make certain that the grantor of the trust would not be taxed on the trust income. As trust income tax brackets increased and individual income tax brackets decreased, however, things changed. and planners decided that it might make sense to prepare a trust that was effective for estate tax purposes, that is, removing assets from the grantor's estate for estate tax purposes, but not effective for income tax purposes, that is, making certain that the grantor continues to be taxed on the income of the trust, even though the grantor is prohibited from receiving the income. For now, estate tax exemptions are high at $11,400,000 for a single person and twice that for married couples. As a result, estate taxes are less of a factor for all but the quite wealthy. Therefore, there's been renewed interest in making gifts that will do the following. First, shift income from those who would pay high income taxes to those who would pay lower taxes. Second, plan to obtain an adjustment to basis for low basis assets in the trust by taking advantage of opportunities to have the trust assets includable for estate tax purposes when the grantor or trust beneficiary passes away. And third, establish trusts in jurisdictions that do not subject trusts to income taxes. The first type of trust listed on this slide is known as an irrevocable non-grantor trust, or ING or ING. Such trusts have been popularized by estate planning attorneys who practice in states that have laws that are friendly to this type of trust. The N in NING or NING stands for a Nevada Irrevocable Non-Grantor Trust. The D in DING stands for Delaware, and the W in WING stands for Wyoming. There are now many more states that now have legislation that's friendly to this type of trust arrangement. When you establish an ING trust, in order to achieve the maximum benefits, you would consider doing so in one of the states that has a law that favors that type of thing. That would normally require a trustee that's located in that state and a state which has favorable trust taxation rules. The trust would be drafted to make certain that either the trust or the trust beneficiaries, not the grantor, are subject to taxation on the income of the trust for federal income tax purposes. Also, when the grantor wants to achieve all three of the listed goals, the trust would be prepared so that, at the grantor's death, the assets of the trust would be included in the grantor's estate for estate tax purposes in order to receive an adjustment to basis at the grantor's death. To summarize, that means trust assets would be includable in the grantor's estate for estate tax purposes, but income on the trust assets would be excluded from the grantor's income. The tax provisions in the Internal Revenue Code that apply to these trusts are some of the most complex there are. The goal is not easy to achieve, but a number of private letter rulings issued by the Internal Revenue Service provide a pretty good roadmap on how it can be done. 678 trusts were included in a previous slide, and you see that they're also listed in this slide related to income tax planning. I already discussed Section 678 trusts, so I won't discuss them again now. Next on the list are techniques that relate to those who have charitable inclinations. When you make gifts to charitable organizations, the gifts are eligible for a gift tax charitable deduction. As a result, gifts to charities are not subject to gift tax. There's also an income tax deduction associated with gifts to charities. When a gift is made to a trust that qualifies as a charitable remainder trust, the trust makes payments to a non-charity beneficiary, usually a person, for a certain period of time, and then, at the end of that time, the remaining trust assets are distributed to the charity. In general, the trust is treated as a charitable trust. The gain recognized by the trust and income earned on the trust assets are not taxed as trust income. Instead, when payments are made to the non-charity beneficiary, the income is passed out to the beneficiary and taxed as part of the beneficiary's income. The next two trusts on the list relate to trusts that own stock issued by a small business corporation which makes an election to be taxed as an S corporation under the Internal Revenue Code. Taxation of S corporations is beyond the scope of this video series, so I won't go into much detail. In general, however, S corporations are not allowed to have trusts as shareholders unless the trust is an electing small business trust, an ESBT or ESBIT, or a qualified subchapter S trust, a QSST or QUIST. Owners of S corporations may be interested in considering transferring S corporation stock to QUISTs or ESBITs in order to transfer income to other family members in an effort to maximize pass-through income deductions related to pass-through trades or businesses. In our next and final part, Part 16, we will discuss transfers in trust to achieve asset protection goals.